Top-down and bottom-up are two different approaches to investing that investors use to analyze and make investment decisions. These approaches involve different methods of evaluating and selecting investments. Top-down approach. Overview. The top-down approach involves starting the investment analysis from a macroeconomic perspective and then narrowing down to specific industries or sectors before selecting individual securities. Process. Investors using the top-down approach typically begin by analyzing the overall economic environment, including factors such as interest rates, inflation, and GDP growth. They then assess different sectors or industries that they believe will outperform in the given economic conditions. Finally, they choose individual securities within those preferred sectors. Focus. This approach is more focused on the broader market trends and economic indicators that may impact entire sectors or industries. Bottom-up approach. Overview. The bottom-up approach involves starting the investment analysis by evaluating individual stocks or securities without much consideration for macroeconomic factors initially. Process. Investors using the bottom-up approach primarily focus on the fundamental analysis of individual companies. They look at factors such as financial statements, earnings growth, management quality, competitive position, and other company-specific metrics. The goal is to identify stocks with strong growth potential or undervalued assets, regardless of the overall market or economic conditions. Focus. This approach is more concentrated on the specific characteristics and performance of individual companies rather than broader market trends. Combination of approaches. Some investors use a combination of both top-down and bottom-up approaches to make well-informed investment decisions. They may start with a macroeconomic analysis to identify potential sectors or industries, and then use a bottom-up approach to select specific companies within those sectors. Choosing between these approaches often depends on the investor's preferences, investment style, and the specific goals of their investment strategy. Both approaches have their merits, and successful investors may adapt their strategies based on market conditions and their own expertise.